Hello investors, welcome to Simpli Stocks. Recently we have seen a lot of correction in small caps and even many good business models are trading in the undervalued zone. So in today's video, we will cover 4 such interesting small cap businesses that are trading at very good valuations due to the correction. You see, when growth is good in the business but stock corrects and starts trading at a higher discount or a lower PE, then just 1 or 2 quarters of results can give it a boost. But we will not go into too many details because we have already covered these businesses in depth many times on our channel. So our focus will be more on understanding the current developments, business growth, discounted opportunity and valuation in them. And yes, as a standard disclaimer, this video is not a buy or sell recommendation on any of these businesses. Our intent here is to help you educate about these business models so that you can study them yourself. With that, let's get started. The first business on our list is a proxy FMCG player, Manorama Industries. Manorama manufactures low-cost specialty fats and cocoa butter equivalents or CBE for companies in the bakery, confectionery, chocolate and cosmetic sectors. These fats are used as a replacement for cocoa and other fats as they are cheaper for FMCG companies. Their business model is such that they source mango, shea, sal seeds from the forests of Africa and India and process them to make these fats. Then they supply their products to companies like Mondelez, Hershey, Ferrero, Nestle, L'Oreal and Body Shop. Manorama has a plant in Raipur and it is currently undergoing maintenance. With this maintenance work, their capacity will increase by 30% and become 52,000 metric tons per annum from current 40,000 metric tons. So this is an important growth trigger here. Additionally, they have purchased 20 acres of land near their existing plant where they will put more machinery and expand in the medium to long term. Since the cocoa prices have increased a lot, FMCG companies are giving a lot of preference to CBE to manage their costs. That is why this business is in focus. You can see this in their results as well, that their sales in H1 grew by 65% year on year. And as the business is growing, the margins are also getting better. So their EBITDA has grown by 131.5% and net profit has grown by 162% year on year. If the company is able to maintain the performance of H1 in H2 as well, then there can be a very good opportunity because the stock is already trading 25% down from its 52-week high after the correction. The sales in H1 were 613 crore and profit was 106 crore. If we assume that they continue this run rate and double this for the full year, then they will be able to do about 1200 crore sales and 210 crore net profit. Currently, the market cap of the company is 7,750 CR. On this, the forward PE comes out to 35 to 37 based on 210 crore net profit assumption, which is a very good valuation for an FMCG or proxy FMCG player. The next business we will study after Manorama is Shanti Gold. Shanti is also a B2B jewelry manufacturer like Sky Gold. It manufactures jewelry for other jewelry retailers in the market like Kalyan Jewelers and Joy Alucas are two of their most famous customers. The market currently has a negative perception around jewelry stocks due to the rising gold rates. But overall, from Titan and Kalyan to Sky Gold, everyone has announced very good results, whether they are from B2B or B2C segment. Plus, one benefit of rising rates is that demand is slowly shifting from 22 carat jewelry towards 18 carat and 14 carat jewelry, and making charges are higher for lower carat jewelry. And you will see Shanti Gold has corrected quite a lot. It is 30% down from its peak and is currently trading at a PE of just 15. However, for Shanti Gold, you have to remember that their profit margins in Q2 were too good. They got the benefit of rising gold rates. When their IPO came in August, what they did was they had purchased gold and kept it at that time. When the price went up, they recorded inventory gains. Therefore, the EBITDA margin, which was 14.7% in Q2, will come down to 6 to 7%. Further, the net profit margin will normalize around 3.5 to 4.5%. Please keep this in mind. Otherwise, overall, this business is doing very well on a small base. Growth is very good here. Their management had given a sales target of 1900 to 2000 crore in sales for this year, which translates into impressive 70 to 80% growth over last year. This is a very good growth rate for a business trading at a P of 15-16, and there is a lot of clarity on their future growth plans as well. They have a manufacturing facility of around 13,500 square feet right now in Andheri, and now they are setting up a large 50,000 square feet facility in Jaipur, because of which their capacity will increase from 2.7 tons to 3.9 tons. Now a humble request, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Coming back to our discussion, the third business we will cover is Zaggle Prepaid Ocean Services. This is also Ashish Kacholia's portfolio stock. He has 2.24% shareholding in it. In very simple words, Zaggle provides apps, websites, and software platforms to companies to manage their expenses. They have many products as per different use cases like Zaggle Save, Zaggle Propel, and Zoyer. Apart from this, Zaggle also provides co-branded and prepaid cards to corporates, and they also provide vouchers by tying up with platforms like Myntra and Amazon. You see, what happens is that as a company gets bigger in size, these small expenses become a big hassle. So, this spend management is a niche but fast growing segment in India. Growth is good in the business. You will see here that business is growing at 40 to 45% rate, and alongside margins are also expanding slowly. In such a case, profit growth will be even better. That is why you will see profit grew by 79%, and net profit margin has expanded from 6.1% to 7.7%. And see, one of the biggest advantages of any tech business is that your platform development cost is one time. After that, your expenses will not increase at the same speed as your sales. Therefore, as Zaggle will keep getting bigger in size, this margin expansion will happen very fast. This year, they are targeting 10 to 11% EBITDA margin, which converts into or translates into a net profit margin of roughly 8%. And in the next 4 to 5 years, management has talked about taking the EBITDA margin up to 14 to 15%. This means that along with the sales growth, we will also see very good growth in the bottom line due to this margin expansion. Currently, Zaggle is 40% down from its peak and is at a P of 40 to 45. If we value it on a forward basis, then PE will come out even lower. For example, last year, their sales were 1300 crore, on which there is a guidance of 40 to 45% growth. On this, taking 10 to 11% EBITDA margin assumption and 8% net profit margin, Zaggle can manage to do a net profit of around 150 CR this year. So on a forward basis, the PE of Zaggle comes out to just 30 to 32, which is a very good valuation for a tech business where growth is so strong. Finally, let us look at BLS International. BLS is in the business of providing visa processing and consular services. Their business comes from governments and embassies of different countries where they manage many services for them like document verification, attestation, visa processing, passport renewal, and so on. They have a 16 to 17% market share across the world. They have also bought three businesses last year: iData, Citizenship Invest, and Adfelis Solutions, which will help them to increase their market share. And with these acquisitions, they will also be entering into some new business segments. BLS is a service based debt free business, and you can see that their return ratios are around 34 to 35%. It is a cash rich company, which means that most of their net profit converts directly into cash and comes into the business. For example, their market cap is currently 13,000 crore, but they have 1,300 crore in cash right now, approx 10% of market cap, which they can use to buy more businesses in the future. Recently, they did spend about 1,200 CR on acquisitions. Even after that, so much cash balance is left. Their management's target is that for the next 3 to 4 years, they will be increasing their sales and profits at a rate of 20 to 25%. So, if we look at everything together, 20 to 25% type growth, cash rich company, high return ratios, and also a market leader. So, it is a very good deal at a PE of 2021. Here, you can also see that BLS is down 40% from its 52-week high. Recently, the Ministry of External Affairs had put a ban on BLS for participating in new tenders. But just recently, the Delhi High Court has dismissed that ban. This is a positive news for BLS. Apart from this, since then, they have also won many new orders. For example, they have received a big order of 2000 CR from UIDAI for Aadhaar Seva Kendras. So you can study this business also once. Now, if you have liked this video, then do give me a thumbs up. If you support us, then we will be able to bring more such videos for you. You can also subscribe to our channel, and I will see you in the next video. Happy investing.